Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And one of them that I bug all the time is George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. I stalked him yesterday over Airbus because we had the CEO on TV, and I was like, George, I need more questions than just, hey, what's up with space? What's up with Boeing is now the better question for today. So Boeing now appointing Kelly Ortberg as its new chief executive officer. The stock is up by about 3.5%. He is a retired veteran of the aviation industry. He is an engineer by training. Is this the guy that Boeing needs? George, is he?
Not so sure. I think it's the guy that Boeing needs for a small period of time, right? Because he was already retired, right? He has he's a great career in aerospace, working at Collins, helping put Collins into RTX. I mean, great experience. He's 64. So my guess is he doesn't have a lot of runway to work at Boeing. I think it would have been nicer to see a CEO that could have put, I don't know, 5, 7, 10 years into Boeing. But look, I think the job is very difficult. And so I think it's going to take a lot out of the next CEO, and so maybe this is an interim as they continue to develop internal candidates for the job. Maybe it's pretty difficult to recruit somebody into this job right now, so could be an interim because of that as well. So again, the strong aerospace background at the component, at the parts maker level, but doesn't look like someone's going to be around for the next 5, 7 years.
All right, George. All right, so that's the CEO. How about on the fundamentals here? I'm looking at the second quarter. Negative adjusted free cash flow, $4.3 billion. You can't like that. Talk to us about kind of the cash flow, the dynamics, and what they need to do.
So we kind of expected that $4.3 billion. To be really honest, not totally sure why the stock is up. I don't think it's Kelly, because Kelly news started the day out, and Boeing, I think, was up about 1. So post earnings were up. We've done this pop. We heard from CFO Brian West during the call. He told us burn was going to be pretty strong in 3Q2. And then the analysts tried to box him in on what burn was going to be for the year. One said it would be closer to 5 billion or 10 billion. He said he wasn't. I think his quote was something like, I'm not smart enough to tell you at this time. So there's just a lot of variability right now. Look, Boeing has to keep taking inventory, taking ship sets from their supplier base to keep their supplier base in business while they ramp up builds. And they had some good commentaries and builds. They talked about the factory kind of putting out 20-ish, I think was the number. And I think total deliveries in the 30-ish range for 737s, rising to 38, shutting down those shadow factories. It's the factories that they have the inventoried airplanes, a lot of 737s, some 787s, and shutting them down by the end of the year. That was, I think, great commentary. We got to the commentary about what's going to go on with the union negotiations. Those are coming up in September. Dave Calhoun kind of told us he, I think, wasn't totally focused on that right now, or couldn't give us puts and takes there. That's incredibly important, right? So if we get into a situation where the union shuts this company down in September, the cash burn this year looks horrible. They're back going to capital markets, looking for a bond raise, which I think everybody on the bond side is scared to death about because they don't want to see a fall to investment grade, or they're going to the equity side, which the equity guys don't want to hear about, right? Because that's dilution. So I think, again, commentary was good around deliveries and things like that, but a lot of variability coming, here around this cash flow burn, and it's super important.
All right, George, thanks so much for joining us. We appreciate it. As always, George Ferguson, Senior Aerospace, Defense, and Airlines Analyst, Bloomberg Intelligence from Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. So it's Fed Day. Everyone's pumped for it. What is Jay Powell going to say? Are they going to signal September? What is it going to look like? We're going to break it all down for you with Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. She joins us in the radio studio right now. All right, Danielle, what do you think? Like, what are we going to get?
I think we're going to, I'm actually going to go with Anna Wong's kind of take on where this is going to go. She and I are thinking in a similar way. Actually, we get to meet in person tonight. But I think he's still going to couch his dovishness. I think he's going to signal September, but I think he's going to signal September softly.
What does that mean? Is he going to whisper it? Like, what is that?
He's still going to say that they're data dependent. He's still going to say that there is the chance that there is a reacceleration in the CPI, in inflation metrics. Base effects kick in the second half of this year that make it a little bit harder to see continued declines in the inflation. On the other hand, looking at real-time inflation metrics, a bunch of bond traders a long time ago introduced me to Truflation, TRU, and that hit 1.51% today, the lowest reading that we've had in the post-pandemic era. They gave me the raw data back to 2012. It's got a 0.97 correlation with headline CPI. We see where this is going. To me, at least, I think the greatest risk, because there's this huge 7-week gulf in between today's meeting and September 18th, is that there's a policy error in the making.
So you say the highest odds is that there is a policy error. Is that another way of saying the Fed's behind the curve? They should have already been cutting?
I think that's what we're saying. I think that's what ADP is saying. I think that's what the Employment Cost Index, the Fed's preferred measure of wage inflation, is saying. We saw a big step down there. Intel, Match, NerdWallet, those were the 3 job cuts that were announced yesterday. It seems as if most companies, when they're announcing earnings, are continuing to say, until we see stronger revenue growth, we're going to keep cutting headcount. So that's disinflationary.
Cool. So because you're here, I get IBs from people who are listening to the show. Thank you so much. So one of the questions is, and it goes back to the bond market, and we're obviously seeing some steady buying come in, particularly in the back end. Where do you think we end the year when it comes to the 10-year? If we're trading right now at 4.09, we're below all the moving averages. Like, we've had a healthy move to the downside in yields.
We have, and we saw kind of this resistance at 4.14 in the 10-year for some time. And now we've broken below that, and I think that it's not a stretch to say that there's going to be a 3 handle. The question is, does the year end south of 3.5% on the 10-year? And again, it's going to be a gauge of the magnitude of the Fed's policy error. If they have to come rushing in September with a 0.5 percentage point rate cut, that could easily spook the markets.
So what does the Fed do when they start? So let's say they start in September. Then what do? They do it every other?
That's a great question, because we saw these kind of unusual pauses. It's not normal to see pauses in a hiking or a cutting cycle, at least in Fed history. Okay. Of course, we're seeing it in other parts of the world, but history tells us that once the Fed gets going, they keep going, and that means 2 days after election, right? The November FOMC is highly unusual. It's a Wednesday, Thursday meeting so that they're not meeting on Tuesday, election day. But it's very feasible that we see another rate cut 2 days after the election.
What happens to the curve?
We will certainly, it will be interesting to see if the curve does not fully uninvert before the Fed cuts rates, which would be, again, unusual, but we don't normally talk about it.
And that would be because front rates are coming down?
It would be because they're all coming down.
Everything's coming down, but the front's coming down faster.
Yeah, indeed.
Even though it's had a pretty chunky move to begin with, but still,
it has. But again, if you start to factor in I remember when they were raising rates, that Powell said unusually large rate hikes. That took me back to The Princess Bride, rodents of unusually large size. It'll be interesting to see if we have unusually large rate cuts.
All right, Danielle, you did some time at the Dallas Fed, and I'm looking at some.
It
of your
sounds
notes.
like I did time at an institution.
Yes, you did time. You did your time, and now you're free. You used to have something down there called the Dallas Fed Manufacturing Uncertainty Index. That's pretty cool. What does it tell you? What are some of the recent data telling you there? Because you always come up with data sets that I've never heard of.
We are seeing unprecedented levels of uncertainty. Hats off to Emily Kerr and her team at the Dallas Fed. They introduced kind of a National Association of Credit Managers index type of question in their most recent survey that came out on Monday. People are not paying their bills. I mean, companies are not paying their bills, and accounts receivable are being stretched out. So these are kind of credit managers' signs that, hey, there's real distress, and it's harder to get credit, which we've been hearing, right, from smaller businesses especially.
Yep.
Is it sector specific in what you're seeing, or is it just maybe like how big those companies are specific?
What was interesting about this, the introduction of these new types of questions, is that they asked manufacturers, servicers, and retailers. And it was retailers that were seeing the greatest degree of distress.
All right, so you believe...
And remember, this is the 8th largest economy in the world, and the 8th largest exporting nation in the world. Texas is a standalone. It is. So,
and then to that point, like, there's a huge amount of products that get shipped out, right? Like
that's right. That's why it's the largest exporting nation, larger than California.
Yeah, and it has a huge
department
too. Like, you guys are staying with us, though, right?
We 20, 30 years ago, you could say that we were an energy-centric economy in Texas. That's no longer the case. Very diversified.
But you're staying with us, right? The United States. You guys are,
yes.
Okay, good.
I
always have to check in every once in a while.
Just not their grid.
There is secession talk. Texas was once a republic, but
I
I think we're staying with the country.
Is that data set, though, at all distorted by hurricanes, et cetera, that you saw?
No, actually no. And that was, again, what was so fascinating was that it was so broad-based across the service sector, across the manufacturing sector, and across the retail sector. And again, that they do some really, really good research as well that front runs the senior loan officer survey on a national level. And that's also showing that it's very difficult to access credit right now.
You believe we're actually in a recession. Is that correct?
I do. And Anna Wana actually kind of agrees. She also thinks that net job cuts began last October. What's fascinating is that when we got the revision out last week from the Bureau of Labor Statistics, it said in its assumption about business deaths. We know what business births were with the birth-death adjustment. We still have yet to have them report business deaths. Their assumption was that small businesses became additive, that fewer small businesses died in the fourth quarter, when actually we saw small business closings rise appreciably from the third to the fourth quarter. The reason I'm going into these details, the risk is that we see a second quarter of negativity in job creation, net job losses. If you see that for 6 months, because the Bureau of Labor Statistics has already said we lost 192,000 jobs in the third quarter of 2023, if that stretches to being 6 months in a row, the National Bureau of Economic Research, the Business Cycle Dating Committee, they're going to have a hard time saying 6 months of job losses doesn't constitute recession.
So when we get the jobs number on Friday, how do I look at that number then? Because obviously, like, the headline print is going to be up, right? But you're saying that on a net basis, like, what should I be keying in on?
Again, I mean, Powell said it himself at the last FOMC that payrolls are overstated. And if you get a number that was originally 494,000 after the revisions that we hear from the BLS, but after the census comes in and gives us actual headcounts from companies, and that 494 with a plus sign in front of it turns into negative 192,000, it's a significant amount of downward revisions, which my mentor at the Dallas Fed told me you always see at inflection points.
How long do you think this recession will be? Because it feels like it's almost a bifurcated economy. A lot of folks would say, I'm not feeling anything.
We have it's like Super K.
Yes.
Super K-shaped economy.
Okay.
I mean, think about how many people at the top of the K are feeling the benefits of having gotten 5.5% on their cash for this long.
Yep.
And yet we're hearing that inflation is becoming more problematic for the lower income earners. And what that is a sign of is, again, what we saw with the employment cost index today. It's that wages are increasingly not keeping up with the cost of living.
So it's not just the Fed today, mostly the Fed, but we got the BOJ finally hiking rates.
Indeed.
The press are looking a little bit more hawkish.
Woo.
Totally. We get the BOE tomorrow. The ECB's already delivered one cut. Do you think that, how do you think that cycle will all play out in terms of, the majority of them are cutting, right? But they're going to cut differently and at different times. And the BOJ is hiking. How does this all play out?
It's interesting that you bring this up because there is so much disparity right now across the pond. We unexpectedly saw Germany fall back into recession a few days ago. Nobody was expecting that. Speaking of exporting nations, they're the world's third largest exporter.
China.
And it's a reflection of China, exactly. So the breadth of the global recession, when you say, okay, Asia's in recession, okay, Germany's in recession, okay, the United States is in recession, that changes how aggressively each individual central bank can behave. And when the Fed finally does go on September the 18th, then the rest of the world will end up falling in line.
Danielle, thank you so much for joining us. Really appreciate it, as always. Danielle DiMartino Booth, for a little bit extended period here on Fed Day. She is the CEO and Chief Strategist at QI Research, based in Dallas, Texas, but we got her here in our Bloomberg Interactive Broker studio today. My stat was Texas' 8th largest exporting economy. That's pretty cool.
Yeah, really cool.
Awesome.
And that's not even counting, Louisiana also has exporting facilities, but that's not counting all the new facilities that they're trying to build too in terms of exports and stuff.
Very cool stuff.
Obviously, I'm talking LNG and oil exports, but still.
Oh, no surprise there.
Shocker. I know, that's surprising to Paul Sweeney.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live. That's the video thing, youtube.com, search Bloomberg Podcast, and that's where you will find us. All right, Kamala Harris has wiped out Donald Trump's lead across 7 battleground states as the vice president rides a wave of enthusiasm among young, black, and Hispanic voters. That's according to the latest Bloomberg News Morning Consult poll. Some pretty big news there on the political front here. Let's check in with Laura Davison, Bloomberg Politics Editor. She joins us here via Zoom. Laura, this seems like a pretty good start in terms of momentum for Vice President Kamala Harris. What are some of the key takeaways from this poll?
Yeah, so this poll we've been doing since last October in all of the 7 swing states that are expected to decide the election. And this is the best that the Democratic challenger to Trump has ever done. This is the first time we have polled Harris. It's a statistical tie, essentially, between the two candidates. She's technically up 1 percentage point, but that's within the margin of error. The other key takeaway here is that black voters, young voters, Hispanic voters are much more likely to vote now that Harris is on the ticket. So this is, been something that the Trump campaign has created their strategy around, of trying to get, pull away at the margins some black voters, some Hispanic support. But this would indicate that perhaps the tides are shifting in Harris's favor on that front.
Well, that was sort of one of my questions, too. Are these voters that are switching, or are they new voters that are swinging these polls?
So we don't yet know totally what that is based on how the poll works, but what we see is that voters who are unsure if they're going to vote are now saying they're much more likely that they're going to vote. So these may be people who voted in 20 who were not enthused by either candidate, who are going to stay at home, or people who maybe have never voted. But, a turnout election is expected to help Harris on this front versus Trump. The Trump folks were, sort of hoping to pull away particularly black men, Hispanic men. But, we're not hoping to see a big surge in turnout that, really helped Biden in 2020 and could potentially help Harris in 24.
Laura, as a former Wall Street person, I tend to follow the money. And Vice President Kamala Harris has had a pretty good run here in the last week or so raising money. Do we know where that money's coming from?
Yeah, so her campaign says they've raised about $200 million, and that's in the first week or so of the campaign. This is largely from small dollar donors. These are people who are going and giving online, and increments of anywhere from just a couple dollars to up to a couple $1,000s. We've also know that her super PAC, this is the group that can accept money in unlimited amounts, has gotten $150 million in commitments since Biden has dropped out of the race. These big dollar donors, people who give millions of dollars, had decided to withhold a bunch of contributions, in order to sort of pressure Biden to get off of the ticket. So now that money is coming back into the fore. Just for kind of some comparison here of Harris, when she inherited the Biden campaign accounts, it had about $100 million. Since then, she's raised another $200 million. So these are really big sums.
How much of this could be also attributed just to momentum? As in, when you have the RNC, the candidate gets a boost. The DNC provides a boost. This is an unprecedented moment in political history, so no doubt the candidate would get a boost.
Yes, and the timing here is all really interesting because, of course, Biden just dropped out 2 days after the RNC. So Trump was expecting to see a big polling boost coming out of that. Of course, just a week prior, that had been the assassination attempt. Leaving the RNC, Republicans were very confident about their chances. And, even Republican operatives were saying one of the things they needed to be conscious of is that they weren't overconfident. Of course, that all switched, just a couple days later. What the Trump team is saying is, look, this is a Harris honeymoon. This is a surge in momentum that will just be a flash in the pan and won't last until November. That's really what we'll be looking for in the next couple weeks of, is she able to maintain both this fundraising edge as well as this polling edge, or do we revert to where, the Biden-Trump race was just with Harris on the ticket in a couple weeks?
How about debates? Are Kamala Harris and Mr. Trump, are they going to debate? And if so, when and how many times?
This is a really big question. So Trump and Biden had agreed to a second debate on September 10th. It was on ABC News. It's very unclear if that is going to happen. Harris has said she wants to do it. Trump has, suggested that he probably will end up debating her, but has thrown a couple wrenches into the system. He says he doesn't really like ABC. He's called them fake news, and said he'd prefer someone like Fox News to host the debate. He's also said he doesn't need to debate because he's already well known and people knows what he stands for, and he doesn't, feel a need to do this. This is going to be an ongoing negotiation. There's also the question of whether there'll be a VP debate. Trump and Biden had also agreed to do one, before the switch up in the race. Harris is still in the process of naming her VP, so we may hear more about that in the coming weeks.
What do we make about the situation in Israel and how that polls, how that is polling for Kamala Harris? Because clearly there is a huge section of voters that is very unhappy about what's happening in Gaza, right? That we're maybe not voting at all for President Biden. But are they coming back in now? Do we know anything along those lines?
Yeah, so what this poll shows is that people who are very concerned about the Israel-Gaza war, and particularly young voters for whom this is a bigger issue, are more likely to vote for Harris. She's taken a softer tone on this. She's been more sympathetic to the humanitarian situation in Palestine, and is, just doesn't have quite the same negatives on this issue that Biden does. One of the things, particularly just with the, events of late of, kind of there being more unrest in the Middle East, is, the Biden administration is still pushing for a ceasefire. Harris is still pushing for a ceasefire. Democrats really want this to be an issue that is working towards a resolution versus, an issue that's flaring up, particularly as students go back to college campuses in a couple weeks. They don't want to see the protests that we saw last spring.
Do the Republicans have buyer's remorse for J.D. Vance? I'm seeing some reporting along those lines.
Question.
Yes, there's a lot of conversations on that. Even on Bloomberg Television, Mick Mulvaney, who's a Trump ally, came on earlier this week and said, no, they're not looking to replace J.D. Vance. But of course, if you're being asked about this, this means that this is at least a conversation that is circulating. Vance has had a rough rollout, just in about the, 2 weeks or so that he's been on the ticket. Some past comments he's made, sort of degrading childless cat ladies have come up. He has had some jokes on the campaign trail that have come across as crass and haven't really landed. So this is a conversation that's happening upon the sort of Republican, elite, the mainstream Republican class, but isn't really reaching the Trump campaign. They have continued to say, JD is our guy, and we're going to stick by him.
Well, is there an equivalent for single cat ladies for single men? Like, is it single men dog owners? Like, I'm not trying to be funny. I'm genuinely curious.
They're called bachelors.
But
eligible bachelor, it's a whole different vibe.
But that's okay. Like, that's a different vibe.
Exactly.
But like, if you're 45 and you have a dog and then live at home and not married, that's still fine.
I think maybe a gamer would be the equivalent there.
A gamer. Okay. So childless cat ladies versus gamers. It gets complicated.
All right.
Hey, Laura, thanks a lot. We really appreciate it. The poll was really interesting to kind of comb through there. Laura Davison, a political editor for Bloomberg News, joining us from Washington, D.C. They also made the great point in the article that a lot of what President Trump is very good at is putting down opponents.
Right.
But having that with Kamala Harris is very difficult when you're also trying to draw over women and you're trying to draw over African Americans.
Yep, tough one. And I don't remember growing up that swing states literally decided the election. You don't even go to the other 44.
It's kind of the same thing.
But back in the day, I thought California mattered, New York mattered, Texas. I mean, now it's just if you're not in those swing states, you're not going to see the candidates, I don't think.
Yeah, which is also interesting when you talk about the VP and sort of obviously Pete Buttigieg has the most exposure because he's already in the White House, but that was interesting.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is Fed Day. We will hear from the Fed at 2 o'clock. Press conference at 2:30. Bloomberg's coverage begins at 1:30. Tom Keene, Lisa Abramowitz, John Farrell will bring it to you. Jeffrey Cleveland joins us here. He's the chief economist at Payden and Rygel, joining us via LA via that Zoom technology thing. Jeff, what do you expect from the Federal Reserve today? A lot of folks are saying pay attention to maybe the tone as it relates to September. What are you looking for?
Well, Paul, happy Fed Day. Beautiful day here in Los Angeles.
So excited, this guy.
I know.
Yeah, I think this is a great day for the Fed to set up for a potential cut in September. They don't need to rush into anything, though. I don't think there's an urgent need to rush rates. We saw to cut rates. We saw very strong second quarter growth. I think the labor market is still doing pretty well, so there's no urgent need. But if inflation continues to cool, like we saw in the PCE data for the month of June, then it's possible by September we will get a rate cut. So I think, setting up that possibility, keeping their options open, and then maybe pushing back a little bit on market expectations. If you, earlier this week, I looked through the end of next year, so the end of 2025, and there were around 7 cuts priced in. So to me, that's more than a fine-tuning operation. That would be, more of a rates I would call slashing operation. So maybe pushing back against the longer-term pricing.
Well, to that point, I mean, the 2-year yield is down 40 basis points for this month. A huge move. And I'm betting that a lot of that happened after July 11th was when we got that CPI number. So if Jay Powell sort of becomes a little bit more balanced or tries to have a message that's more balanced here, what's going to happen in the front end of the bond market?
We think we're in a soft landing, and that's sort of the scenario we're in. We'll be in the soft landing over the next 6 to 12 months or so. So in that environment, I think moderately lower Treasury yields make sense. 2-year yields, 5-year yields, 7/10s, what have you. So that makes sense. On the short-term basis, though, I think the market is far too confident over the September cut. You can be in a soft landing and cuts arrive later. So probably in the short term, in your scenario where, Chair Powell pushes back a little bit, we will see some upward pressure on 2-year yields. Another candidate for some upward pressure would be Friday's jobs report. We get a decent jobs number, but also, we've been watching the last few months the unemployment rate creep up. It's possible the unemployment rate will tick down this Friday, and that will pour some cold water on these sort of bearish calls about the Fed. Needs to do something now. The economy is weakening, and that could have impact on 2-year Treasury yields.
And Jeffrey, Alix and I had one of those discussions earlier today with Danielle DiMartino Booth, who feels like this U.S. economy is already in a recession if you really take a look at the real-time data, and that the Fed they're actually behind the curve. They should have already been cutting. How do you respond to that when you hear that amongst investors?
Q2 GDP grew 2.8% quarter-to-quarter annualized. On a year-on-year basis, it was up 3%. The consumer continues to be solid. The unemployment rate has creeped up. It's still low. That's 4%. That's very low historically. Initial claims for unemployment insurance layoffs, pretty good, reliable indicator of whether we're in a recession or not. Very low still. So I don't know. And I've been hearing this story for probably 8 quarters now. I think since 2022, people said, if the Fed starts hiking, they're going to pull the rug out of the economy, out from under the economy, Paul. It just hasn't happened, right? Yep. The economy keeps going.
Well, but here's the problem, right? Is that it's a K-shaped economy where the lower and middle income houses are getting continually squeezed, and the upper income are enjoying 5% on their Treasury bills. So with that, I mean, I know that that's nothing unusual necessarily within the economy, but does that put a little bit more pressure then on the Fed?
Well, I think if you're the Fed, you are looking at inflation. It has moderated, especially in the last 2 months. similar to what we saw maybe in the second half of last year. If that continues, you could very easily, Alex, be back to 2.3% year-on-year core PCE sometime next summer, which is close to target. So that's good. At the same time, the unemployment rate has crept up. So they don't want to just be restrictive, stick at 550 for the foreseeable future. So they are aware of that. And, I think that's a good argument for fine-tuning the Fed funds rate. You don't need to be at 550 if inflation's at 2.3 and the unemployment rate's creeping up. Now, do you need to slash back to 2.5% or 3%? Probably not either. It's more of a fine-tuning operation. I might have mentioned it on this show before, but, like the mid to late 90s is more of the historical analog, if you will, for what I sort of envision. The Fed did cut a few times in there, but growth continued throughout that period. Stocks did well, bonds did well, so it was a good environment.
So overall, in terms of the consumer, how do you feel like the consumer is faring out there?
I think, for me, job growth continues. You have more people working. They're still earning wages, although wages have, cooled off a little bit to about 4% year on year, what we're seeing in the ECI data. It's inconsistent what we've been seeing in average hourly earnings. But it's really income growth that drives the consumer and consumer spending. And that is still holding up through the latest set of data. We'll get an update on that on Friday. But I think that's really key. Separate from that, Paul, you can think about household net worth still looks pretty good. We still think households have savings. If you look at household debt service as a share of their disposable income, those ratios are still quite low, even though rates have crept up. So all in all, I think the consumer is in decent shape still.
All right, let's pretend. Oh, no.
No, sorry, go ahead.
I was going to say, before we let you go, what would be the question you'd ask Jay Powell if you're in the presser?
Well, I would ask him, hey, what do you think about the unemployment rate rise? We've gone from, 3.4% last spring. We're now 4.1. How concerning is that to you? How much is that weighing on you in terms of the decisions you will make? I might also ask him, hey, the market thinks you're definitely cutting in September. What is the one thing that would really change your view? I think it would be core PCE, coming in month to month hotter in the next couple of months, choppy inflation, but I think that's a worthwhile ask.
All right. Thanks so much. We really appreciate it. And I would love it if you went into a press room and was like, hey, Jay, tell me about this. All right. Jeffrey Cleveland, Chief Economist over at Payden Rygel. Super appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You're listening to Bloomberg Intelligence. Alix Steele and Paul Sweeney live here in our Bloomberg Interactive Broker studio. All right, here's a company for you. I had not heard about it until recently. Trane Technologies. I believe they're based in Ireland, but they are a global climate innovator focused on sustainable solutions for buildings, homes, and transportation. Carolyn Ubelhart from Bloomberg Intelligence, she covers this stock, and she's a grizzled veteran. She is not given to praise companies unnotably. She says they had a great quarter again. Amazing company in a very attractive sector. So when she told me that, I said, we got to get these guys on Bloomberg and see what's going on with this company. Dave Regnery joins us. He is the CEO of Trane Technologies. The ticker is TT on your Bloomberg terminal. Stock hit a 52-week, and actually I'm going to call it an all-time high today on the back of some pretty good numbers, earnings and sales beat on consensus. Dave, thanks so much for joining us here in lovely Davison, North Carolina. Talk to us about your company. What's driving the performance of Trane Technologies these days?
Well, first, Paul, thanks for having me on the show. I just got off our earnings call, and we reported a very strong second quarter, much like we did in the first quarter. Our organic revenue growth was up 13%. Our order rates were up 19%, and our EPS growth was up 23%. So very proud of what we've been able to, how we've been able to perform. Look, as far as what's driving our growth, I always tell people we have a system of things that makes Trane Technologies a great company. And whether it's the way we operate our facilities through our business operating system, whether it's the way we innovate our new products, or whether it's our direct sales force, those are a system of things that make us a great company. And we have a service business that's a third of our company. that's performing extremely well in the second quarter. Our service business was up mid-teens from a growth perspective, and we have a culture that's, we believe in challenging what's possible and innovating for a sustainable world.
So based on that, it's great to chat with you, by the way. I love talking to you because you have such a great read on the residential and commercial businesses. Basically, you have a commercial HVAC unit and a near-term residential HVAC unit. And of course, that's heating, ventilation, air, and cooling. Where's the strength? Where's the growth? Where are the weak points?
Yeah, I'll start with residential. We had a very strong quarter in the second quarter. Our revenue was up mid-teens. Low teens. But that our residential business for the prior, I'll say, 3 quarters had really been struggling with a refrigerant change that wasn't clear. That's been clarified. It was really struggling with excess inventory, kind of a hangover from the COVID days that was in the channel. Those both corrected, and we're off to a very warm start to the cooling season, which should have us all concerned for a different reason. As the climate continues to increase in temperature. But I would tell you that it's a very strong start to the year. So very strong in residential. Our commercial business, really broad-based growth. Certainly the high growth verticals like data centers, we do very, very well in, or education, or in healthcare. But we had broad-based growth. In the Americas, we track 14 different verticals. And we were hard pressed to find a vertical that we were not strong in. So it was a very strong quarter for Trane Technologies. I'm very proud of what the team's been able to accomplish.
Yeah, I'm reading the Bloomberg Intelligence research note out on your earnings. North America's 16% organic growth was much greater than the 10% consensus. What drove that?
Yeah, really 2 things. Our residential business performed better. Okay, we thought that was going to be, in the beginning of the year, we thought our residential business would be low single digits. We came in, low teens in the quarter, so we significantly outdrove that. And then our commercial HVAC business just continues to operate at a very high level. And like I said, services was up in the high teens actually in the Americas, and their equipment business just continues to exceed our customers' expectations. So very strong quarter. I was listening to your show earlier. You were talking about sustainability, and I would tell you that at Trane Technologies, our purpose is built around sustainability. And what people are talking about right now is you're hearing a lot about how much power is going to have to be generated to meet the demand that's coming, and you'll hear a lot about data centers using a lot of the electricity. What nobody is talking about is the amount of power that's being generated that's being wasted. And I would tell you, we call it demand side management. And we know, because we've done hundreds of thousands of energy audits in buildings, that most buildings operate about 30% inefficiently. So just think if we could solve that problem. And if we can make buildings perform the way they were designed, or assets perform the way they're designed, just think about the amount that we could save in the energy that's being produced, and which obviously has a trickle effect to the carbon footprint. So that's what Trane Technologies is all about. People always ask me, where do you see the growth coming from? It's going to be on the demand side management side.
Hey, Dave, we really appreciate it. Definitely come back. I know you got to run, but we appreciate your time today. When you're in the city, come in and tell us more about it, and I'm also curious as to those customers. Are they willing to pay up for it? We got lots more to talk about.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to the market, shall we?
Let's get back to ETFs.
Ooh.
Talk about a growth business. Jennifer Grancio joins us here. She's Global Head of Distribution for TCW. That's a trust company of the West. Los Angeles based, used to be a huge client of mine. They loved me. She joins us here in our Bloomberg Interactive Brokers studio. Jennifer, the money just keeps flowing to you guys, and it's just unbelievable how your market is growing, the ETF market. Where's some of the money going now? Are folks looking for income? Are they looking for special situations? What are they looking for these days?
Yeah, from a TCW perspective, people know us for fixed income, and so we have a developed set of equity ETFs now, but we launched the first fixed income ETF recently.
Okay.
And the ticker, because that's what we do in ETFs, is Flexor, FLXR. But Flexor and strategies like it are giving you return in the fixed income portfolio, but they're also giving you very consistent income. And if you think about how to actually construct a portfolio, equities can be volatile, money market funds and rates, they will go down eventually. And so we see a lot of investors looking for products that are giving you return, but they're also giving you this consistent income.
This might be a really silly question. Are these actively managed ETFs, or are these boring? Not boring. I mean, just passive ETFs.
We at TCW, we have one index ETF, and everything else we do is active. So our view on portfolios right now is there's a lot of uncertainty in the market, and particularly when it comes to fixed income and bonds, we think active management is the way to go. We can make a lot of choices about how to both manage your risk and optimize return, and in the case of a product like flexible income, optimize income at the same time. So we think active is the way to go in the current market.
And what's interesting about your MetWest flexible income, it was a mutual fund. So you converted a mutual fund into an ETF. Why do that?
Advisors like to invest in portfolio managers that have a long track record. They want to know that the team's been around and together and been making these choices on risk and return for a very long time. So at TCW, we have an excellent fixed income team. They've managed this particular strategy for 6 years with very high performance versus peers. And so in this case, it's logical for us to take that great track record and simply flip it into an ETF vehicle.
This might be also a silly question, but if the Fed starts cutting rates, does the appeal of an actively managed fixed income ETF become less? Because we're no longer going to be at 5% like money market fund rates, for example.
Well, I think we're not going to be at zero either. And so the way that we would think about it is if you're moving through time for years ahead of us, there really is an opportunity to be active, to drive return in the fixed income part of the portfolio. And frankly, from an income perspective, people need to keep up with inflation. So inflation's down somewhat. But from a price perspective, particularly aging population, if everyone's living till 90 or 100 years old, there are a lot of portfolios where the regular repeatable income, in the case of flexible income, it's say 7% yield. So as money markets go down, we're actively able to manage to a higher income target.
All right, you guys in the ETF business, I understood the passive ETFs. I got that whole story and the cost. Then you guys brought in active ETFs. I'm like, well, wait a minute. I think managers, analysts, overhead costs. So is an actively managed ETF cheaper than a mutual fund?
In some cases they will be. In some cases, maybe they won't be. So in this case, with flexible income, we actually brought the cost down because we see the demand from an ETF perspective, and we think the fund is going to grow. And so we were able to take an active product that is a 40 basis point fee. But that 40 basis point fee is actually lower than when we were managing it in a mutual fund, and that brings real value to clients.
How about to you guys?
Well, for us, we're building a business, and we think that there's real demand for products like the one that we're talking about today. And so as that product grows, it's a great business for us to be able to serve clients with a product that can really scale and grow in assets under management.
Now, Jennifer, before you were at TCW, you were the CEO of Engine Number One. TCW acquired that part of the firm's business back in October of 2023. I'm an oil nerd, so I think Engine Number One, and I'm thinking, the really successful shareholder push on Exxon to get 3 members on their board to really push for climate change. Can you walk me through all of that?
Yeah, so from an Engine Number One perspective, we saw an opportunity in the market where people were investing in energy transition or transformation, either not investing in holding index funds or investing in private equity. So a lot of what we did at Engine Number One was build a public market products. Exxon was a big part of that, still a big holding in one of the funds that came over to TCW, which is another ETF, NetZ. And the idea there is that we are going through an energy transition over many decades to come. And so in the case of working with Exxon, helping Exxon realize they could optimize their business and capital allocation to not waste money in the out years, but take advantage of what was happening in the next 10 years. And that's that work has added a lot of value to everybody that has held Exxon over this period. And at TCW, we still manage this energy systems transition fund.
So to that point, I mean, that was also when energy transition and green and climate, the pendulum was swinging very much one way, and the pendulum is swinging back the other way. Are you guys noticing anything now at TCW on that?
Well, we're at TCW, we're probably one of the leaders in looking at companies from an underlying risk and reward perspective across climate and governance, for example. And so we're a leader in that. That's a big part of our business in Europe. In the US, people may not want to buy products that are value screened, but we still do the work, so that we're doing the work so that if there's a company that's mispriced based on a climate risk or mistakes on the governance side, we understand that, and that's information that goes up to our fundamental portfolio managers. And it's just another way we're adding alpha for clients.
Interesting. So where from the ETF business for TCW, what's next for you guys? Where's the area of focus? Is it continued on the fixed income front?
It is for sure continuing on the fixed income front. So we have a set of equity products. We'll build to that over time. Excuse me. But on the fixed income side, we've got flexible income out in the market now, and we've filed for another 4 to 5 products that may be out as soon as the end of the year. Because what we see is people want the best solution in fixed income portfolio construction. And so what we do as active managers, whether it's in the CLO market, secured bank loans, high yield, we think we can deliver, very attractive and more competitive than other people are out there today, return and risk profiles. And so we look forward to launching those ETFs shortly.
Can I go back to climate for a second?
Go.
Well, Paul hate me here. You mentioned that you are helping to judge climate risk and you pass it on to the managers. How do you judge climate risk for a company?
It's different for every company.
I know.
And so,
how do you do it?
Yeah, I mean, so the way we do it is look at each company at an underlying data level. So if a company is in the energy sector, what are they doing about capital allocation in old, world energy? What are they doing to improve or green up in other areas? So we're looking at that. And then across most large companies, we're looking at water use, electrification, the goals that they're setting, and then measuring the progress that they're making against those goals. So we don't look at it in a carbon footprint only. We look at it as a sort of transformation, transition. How are they planning? How will they beat their competitors effectively in doing a better job as we move through time and we move through the transition?
So cool.
I don't know how you invest in energy companies, because do I want my companies going green now or just waiting?
Well, that's part of the problem is that if you're a big energy company, or if you're an investor, you really only want to own one, because you can't own a bunch for that exact reason. And you can't go to shareholders or your investors and say, hey, I have a boatload of energy companies. So then that begs the question, how do you choose, which means bigger is better, and then hence fourth and Exxon, Chevron kind of thing. That's what I keep hearing. Chevron, Exxon earnings out Friday, so very exciting. This was great. Jennifer, thank you so much. It was wonderful to meet you. I'm a big fan of Katie Koch also, who's the CEO of TCW, so it's great to get you in the studio. Come back anytime. Jennifer Grancio, Global Head of Distribution over at TCW, normally based in LA, so we're very lucky to have her here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.